If you've been watching this cycle unfold, you've probably noticed something different about 2025. The wild, anything goes speculation that defined past altcoin seasons feels muted. First-time investors aren't chasing microcaps the way they did in 2021, and the few that do are learning hard lessons fast. Historically, the first wave of new retail participants tends to flock to cheaper coins, anything trading under $1, with the belief that lower prices mean higher potential upside. It's the same pattern that's repeated across every bull cycle since 2017. New entrants scroll through CoinMarketCap, see Bitcoin at 6 figures, and assume they've missed the boat, so they buy the lowest price assets they can find, hoping for 100x returns. That behavior fueled entire manias, from the 2017 ICO bubble to the 2021 meme coin and NFT frenzy. But in 2025, the landscape looks different. Retail investors are far more cautious, and institutional capital now drives much of the liquidity. The average newcomer today has likely already lived through 1 or 2 full crypto cycles, or at least watched them from the sidelines. They've seen altcoins fall from 80 to 95% during bear markets and learned what survives: Bitcoin. That experience, what some analysts call scar tissue, has fundamentally changed investor psychology, and you can see it in the data. On-chain metrics show that Bitcoin's long-term holder supply has reached an all-time high, with over 14.9 million Bitcoin unmoved for more than a year, according to Glassnode. At the same time, altcoin trading volume as a share of total crypto volume has fallen from about 58% at the 2021 peak to around 42% this quarter. That's based on CoinGecko data. And this shift isn't just emotional, it's structural. Institutional products like Bitcoin and Ethereum ETFs now account for over $55 billion in combined assets under management, according to CoinShares' October 2025 report. That's more than 10 times the combined assets under management of all altcoin-linked ETPs globally. Capital is consolidating around what institutions perceive as safe exposure. That's Bitcoin and Ethereum. And yet, the narrative of altcoin season, the idea that after Bitcoin rallies, capital rotates into higher risk assets for outsized gains, still lingers. It's the rhythm most long-term traders expect each cycle. But so far this year, that rotation has been weaker and more selective than ever. And the data supports this too. Bitcoin dominance, that's the Bitcoin share of the total crypto market cap, remains around 58 to 59%. That's slightly below its July peak of 65%, but still far higher than the sub 40% levels that defined previous alt seasons. Now, historically, dominance needs to break below roughly 54% to trigger broad altcoin rallies. Until then, the capital flow remains top-heavy, concentrated again in Bitcoin and Ethereum. So the real question is, why? Why is speculation more subdued in 2025 when liquidity conditions, regulatory clarity, and ETF adoption are arguably better than ever? The answer lies in the maturation of the market and the scars of its participants. Investors have evolved. The data shows it. And as we move deeper into this cycle, the contrast between past and present becomes even clearer. The quieter altcoin market of 2025 isn't random. It's the result of several measurable shifts in investor behavior, market structure, and macroeconomic conditions. That together has drained the fuel from the kind of euphoric rallies we saw in past cycles. So let's start with investor maturity. After 2 brutal bear markets in less than 5 years, crypto investors have developed what can only be described as collective memory. Many who bought altcoins in 2021 or 2022 watched their portfolios collapse 80 to 95%. That experience left a lasting mark. On Twitter, Reddit, and Discord communities, you can see a clear cultural shift. Fewer calls for moonshots, and far more discussions about portfolio preservation, yield strategies, and Bitcoin accumulation. Glassnode data backs this up. Long-term holders now control over 70% of Bitcoin's circulating supply. That's the highest in history. Meanwhile, altcoin turnover, the percentage of total supply traded monthly, has dropped nearly 40% from the 2021 levels, suggesting less speculative churn. Institutional presence reinforces this stability. As of October 2025, Bitcoin and Ethereum ETFs hold a combined $55 billion in assets under management, led by BlackRock, Fidelity, and Grayscale. These products channel liquidity toward the majors and away from speculative altcoins. Institutions seek risk-adjusted exposure, not 100x meme coins. The result is steadier capital flows, but less excitement, but far more resilience. Bitcoin dominance currently sits near 58 to 59%, up from around 48% a year ago. Historically, broad altcoin rallies begin only when this metric falls below roughly 54%. In 2021, for example, dominance dropped to 39% right before the peak of that cycle's alt season. So today's elevated dominance tells you where the liquidity is sitting and where it's not moving yet. We can see this reflected in stablecoin data too. Roughly $775 million in fresh inflows have entered Ethereum-based stablecoins since mid-September. That's according to DeFi Llama, but total stablecoin supply growth remains modest at around 2% month over month. That suggests liquidity is present, but it's cautious capital, not retail FOMO. Until dominance falls and stablecoin issuance expands rapidly, the setup for a classic alt season just isn't there. Another major difference this cycle is simple oversupply. There are now over 2.4 million tokens listed across various chains. That's according to CoinGecko. Triple the number from 2021. Platforms like Pump.fun and Base Meme Launchpad make it possible to spin up a token in minutes with virtually no barrier to entry. While this democratizes creation, it also really dilutes investor attention and liquidity. Capital that once concentrated into a few strong altcoins now gets spread thin across thousands of speculative assets, leading to what analysts call micro seasons. That's brief, isolated pumps rather than market-wide rotations. Now, on top of that, high, fully diluted valuations and constant token unlocks continue to apply downward pressure on prices. Token unlocks data shows that between August and October alone, over $8.6 billion worth of vested tokens have hit the market. That's equivalent to nearly 10% of total altcoin liquidity, a constant supply overhang that keeps rallies short-lived. Even the macro backdrop plays a role. Yes, global liquidity has improved. The Federal Reserve and European Central Bank have collectively injected nearly $2 trillion through rate cuts and balance sheet expansion since mid-2024. Printers gotta print. But risk appetite remains muted. US household debt now sits around $18.39 trillion, a record high, limiting how much new retail money can flow into speculative assets. Meanwhile, regulation continues to favor Bitcoin and Ethereum. ETF approvals have legitimized them as safe crypto exposure, while altcoins face ongoing scrutiny. The SEC's case backlog still includes unresolved classifications for several large cap tokens, keeping institutions on the sidelines. Without a unifying narrative like DeFi in 2020 or NFTs in 2021, altcoin markets lack direction. Emerging themes such as AI tokens, real-world assets, and Layer 2 scaling solutions are promising, but they're still fragmented. One of the simplest ways to visualize this shift is through the Altcoin Season Index. Historically, readings above 75 mark the beginning of a true alt season. That's when 75% of the top 50 coins outperform Bitcoin. In late 2021, the index held above 90 for several months. Now today, it's hovering around 33, firmly in Bitcoin season territory. Even after brief rallies in August and September, it failed to break above 60 before rolling over again. And that tells you everything. Investors are still cautious, capital remains concentrated, and speculation, at least for now, is disciplined. So when people say this cycle feels calmer, it's not just a vibe, It's visible in the numbers. The scars of past volatility, institutional weight, and structural dilution have all combined to create the most selective, data-driven crypto bull market yet. Now, to understand what's happening in 2025, you have to look back at 2021, the last time the crypto market saw a full-scale altcoin season. On the surface, both cycles shared similar catalysts: Bitcoin strength, liquidity injections, and new narratives. But beneath that, the structure of capital, sentiment, and performance looks entirely different. So the data tells the story clearly. During the 2021 cycle, the altcoin season index held above 75 for months, peaking at 98, meaning nearly every major altcoin outperformed Bitcoin. In contrast, the 2025 cycle briefly reached 84 earlier this year, but has since dropped into the 39 to 73 range, well below the 75 threshold needed for a true alt season. Bitcoin dominance is another clear contrast. In 2021, it collapsed below 40%, freeing capital to rotate aggressively into altcoins. But this year, dominance remains elevated around 58 to 59%. And historically, it needs to break below 54 or 55% before altcoin rotations gain serious traction. Now, performance reflects the same pattern. Large cap altcoins in 2021 saw average gains of 170 to 200%, with many smaller projects exploding 10x or 100x in a matter of weeks. In 2025, the gains are far more selective. Total altcoin market cap has grown about 50% year to date, but concentrated in a few sectors like AI, RWAs, and Layer 2 networks. The broader alt market remains flat to moderate. Even the total market cap growth shows the shift in leadership. The 2021 rally brought crypto to roughly $3 trillion, driven by altcoin enthusiasm. Today, the market stands near $3.8 trillion, but this time it's Bitcoin-led, with ETFs and institutional inflows providing the foundation. Altcoin trading volumes hit all-time highs on exchanges, but that volume has come with shorter and, again, more fragmented rallies. Duration and timing have also changed. In 2021, the euphoria lasted 3 to 4 months, a clear, fast rotation from Bitcoin into altcoins. In 2025, we've seen short-lived mini rallies every few weeks, but no sustained wave yet. Analysts now expect any meaningful alt season to be delayed until Q4, depending on macro conditions and capital flows. The driving forces behind each cycle couldn't be more different. In 2021, altcoin performance was fueled by retail FOMO, a flood of post-COVID liquidity, and a smaller universe of tokens competing for attention. Bitcoin rotated cleanly from Bitcoin into alts and from large caps into smaller ones. In 2025, institutions set the tone. ETFs, macro-linked rate cuts, and Bitcoin's dominance have reshaped the flow of capital. Oversupply, token unlocks, and inflated, fully diluted valuations have diluted attention, breaking one massive altcoin season into smaller, sector-specific bursts. The emotional landscape has also evolved. In 2021 was marked by euphoria, new retail money, viral influencers, and get-rich-quick narratives. Fear and greed cycled quickly. But in 2025, sentiment is cautious. Investors prioritize liquidity and quality, with discussions on Twitter dominated by warnings against low-float traps and reminders of 2022's drawdowns. The community has aged, excitement is tempered by experience. Each cycle carried unique risks. The 2021 bull run ended with broad pumps, followed by sharp, synchronized crashes as liquidity dried up and leverage unwound. In 2025, risk comes less from leverage and more from oversupply, spam tokens, and regulatory uncertainty. These create slower bleedouts rather than instant collapses. The result is a cycle defined by selective rallies, not explosive rotations. Still, patterns do repeat. Every alt season starts with Bitcoin dominance forming a cup and handle pattern, followed by brief corrections before liquidity rotates outward. We've seen early signs of that again in 2025, smaller alt surges after Bitcoin pullbacks and liquidity injections following global rate cuts. The mechanisms remain, even if the amplitude has diminished. Ultimately, 2021 was retail-led and explosive, a market of emotion, hype, and concentrated opportunity. 2025 is institutional and selective, a market of structure, liquidity discipline, and maturing ecosystems. Both follow the same rhythm of capital rotation, but one danced to retail excitement, the other moves to institutional caution. If you've been waiting for the kind of explosive alt season that defined 2021, patience is a key word for 2025. The structure of this market suggests that while a rotation is possible, it will look very different from what most investors remember. Current conditions still leave room for a delayed rally. If Bitcoin dominance drops below about 55% and the altcoin season index climbs past 75, history suggests a wave of capital could rotate into quality alts. Several analysts expect the window for a broader move in Q4 after election uncertainty fades and rate cuts filter through markets. If that happens, the most likely beneficiaries are projects with tangible cash flow or adoption metrics. AI infrastructure, layer 2 scaling, RWA protocols, and DePIN networks that connect on-chain incentives with real-world usage. Those sectors already show measurable traction rather than just speculative chatter. So the takeaway really is simple. This isn't a market that rewards chasing everything that moves. It rewards selectivity. In past cycles, owning 50 small caps felt exciting until liquidity dried up. Today, disciplined positioning, fewer assets, stronger fundamentals, and a clear plan wins over diversification by hype. History also shows that the best opportunities often appear right after periods of doubt. You guys remember October 10th this year? Many of the strongest altcoins of 2021, including those that went on to 10x, first retraced 60 to 70% before their breakout. That pattern may repeat, just in slower motion. But when rotations come, they tend to reward patience and preparation, not emotion. The broader lesson of 2025 is that crypto is maturing into a two-tier market. Bitcoin and Ethereum anchor institutional portfolios, setting the rhythm for liquidity, while selective altcoins form smaller, faster waves within that structure. Dramatic, retail-driven alt seasons may never fully return in the same form, but what replaces them could be healthier, more sustainable growth built on real utility rather than speculation. So if dominance eventually rolls over and the altcoin season index confirms above 75, we could still have a strong finish to this cycle. But whether or not that happens, the winning strategy remains the same. Focus on fundamentals, manage risk, and stay grounded in data instead of emotion. If you want to keep building that foundation, understanding not just what moves markets, but why, visit learningcrypto.com. It's where you'll find market breakdowns and strategies designed to help you make informed decisions through every cycle, not just the hype phases. Thanks for watching. I'll see you in the next video.